Good evening and welcome to this session of the live virtual coaching classes organized by the Board of Studies of the Institute of Chartered Accountants of India. We have been discussing a topic called share capital and debentures. And yesterday we made some beginning and we started doing it. Now we are into this and we covered quite a lot of ground. We came all the way up to dematerialization and then we moved on, etc., etc. Give me 2 minutes to sort of connect up. We have Alokji, we have Chatan Gada, and we have Jyotija, all of whom have sort of logged on. We have others also. Wow, so many people have come. And moving on. So to everybody, good evening here. And as usual, let me pray to the internet God, as we know, because just as I was going to start, I had a connectivity problem. So let me see. Sahana vavatu, sahano bhunaktu, sahaviryan karavavahi, tejas vinavadhitamastu mavid vishavahi, om shanti shanti shanti. So that's good. Now I've got so many people putting in good evenings there. I can't mention all of their names, but there are some questions. So let's continue with that. Mr. Dhyanesh talks about what is the meaning of resolution passed before the company. Maybe you got it wrong. No resolution is passed before the company. It is passed by the company. By the company. A resolution passed by the company could be an ordinary resolution or a special resolution. What is the difference between subsisting default and default? It's a good question relating to this one. See, when you are issuing differential voting right shares, right? There might be a default in payment of preference dividend. Now that is, if it is continuing as of the date of issue of the differential voting right. See, you want to issue differential voting right shares. On the date of the differential voting rights issue, if the default is there, it is the subsisting default. But if already you have made it up, closed, then it is not a subsisting default. If you go back to your differential voting rights, there are certain defaults which if you rectify it, you can issue. But there are certain defaults, even if you rectify it, you cannot issue DVR for 5 years. You have to wait for expiry of 5 years. Subsisting means present as on the date of deciding to go for a differential voting right share. Okay, that's what subsisting means. Okay. Default is any failure to comply with the law is a default. If it is continuing as on the date, it's called subsisting default. So now we move on to the next topic. As you are aware, when there are partly paid shares, then the remaining portion, in the case of partly paid shares, calls have been made only for a portion of the share. Okay, so the balance portion on which calls are yet to be made is called uncalled portion, right? So whenever we make a call, okay, when calls are made by the company on security holders to pay the amount due in respect of partly paid up securities. Now these calls have to be on uniform basis on all shares in that class. And there should be no differentiation of a given class of security holders. For example, let's say you are having partly paid shares. On all the shares, 3 rupees is to be paid up. 3 rupees to be paid up. Now, let us say that there are 1 lakh shares on which 3 rupees is to be paid up. You cannot say those people who hold 1,000 shares and above, okay, you have to pay 3 rupees. Balance, it is enough if you pay 1 rupee. Something like that. 1,000 shares and above. Balance you pay. Others holding less than 1,000, you can pay only 1 rupee per share. Whatever may be the intention, the calls made should be uniform. Okay, uniform. Calls in advance. Just like when I make a call, somebody does not pay the call, it is called calls in arrears. Suppose I made a call on 1 lakh shares, I made the call of 3 rupees. Then everybody should pay the call. If they pay, then I'll get 3 lakhs, right? Suppose 10,000 rupees or 30,000 rupees is pending. Okay. 30,000 rupees is pending. On 10,000 shares, 3 rupees is pending. Then that is called calls in arrears. Okay, calls in arrears. You know this. I'm maybe wasting your time. Calls in arrears. Now, on important point, while calculating dividend, we will calculate only on the amount paid up, not on the nominal value for partly paid shares. If there is any calls in arrears, it has to be reduced. Okay, and you cannot pay where there is a call in arrears. You cannot pay. Suppose all shares are fully paid up, except these 10,000 shares on which 3 rupees is to be paid. You should not pay dividend on that 3 rupees, which they have not paid. Only on the 7 rupees which they have actually paid. That is calls in arrears. Similarly, suppose when you issued the shares, you called up only up to 7 rupees. Okay, maybe you had 2 rupees application money, 3 rupees allotment money, then another 2 rupees calls first call. Now, at the time of first call, somebody said, like, look here, don't keep wasting my time. Here is 5 rupees, take it. I've got 1,000 shares into 5 rupees, 5,000 rupees, take it. Adjust 2,000 towards your current call. Balance 3,000, keep it. And whenever you make that call, adjust it. That is called calls in advance. So, company can accept calls in advance only if authorized by its articles. So, there should be an authorization in the articles for acceptance of calls in advance. Okay. But on calls in advance, no voting rights can be exercised. For example, this gentleman who has paid calls in advance cannot say, I'll get higher proportion of vote. No. He'll have the same vote that everybody has. Okay. Can I pay dividend or interest on calls in advance? You can, provided it is authorized by the articles. So if there is no provision in the articles for payment of dividend on calls in advance, you cannot pay dividend on calls in advance. Okay. So this is basic information. Okay, Dhyanesh, okay, let me clear this. Placed before the company means presented to the company for passing a resolution. So, whereas you said passed before the company, remember, go back to your own comment there. You have used the word passed before the company. Whereas now you are using the word placed before the company. Placed before the company means presented to the company for passing a resolution. When a resolution is presented or when a matter is presented, okay, to the company for passing a resolution, it is called placed before the company. If a company has allotted shares on pro rata basis, why it could not be called as calls in advance? Yeah, you can if you want. See, at the time of application, there was excess application money received. So based on pro rata allotment, you allotted. So the amount paid in excess is held. Yeah, that is kind of calls in advance. Yeah. Strictly, it's not a call in advance. It is money to be adjusted against allotment money. So that could be taken. Yeah, technically, yes, you can call it calls in advance, though it's not a call. See, calls come later. This is at the time of application, you would have taken some money. Then later on, you would have taken for allotment again, you would have taken some money. That this will be adjusted against the allotment money. So it's okay. If you are going to be very strict about it, I leave it to you. I don't mind calling it calls in advance. Because what they say, accept any member, the whole or part of an amount remaining unpaid on any shares. Okay, so they are not talking about calls. Only we have given the term calls in advance. Whereas the section does not use the word call. Okay. They are saying remaining unpaid on any shares, even if no part of that amount has been called up. So any amount remaining unpaid, if it is to be adjusted, it can be treated as calls in advance. So these are all splitting hairs. You understand, Abdul? We are splitting hairs here. We are wasting time on this. Okay? Not important. But I will answer. But I'm saying we are splitting hairs here. What I mean by splitting hairs is small differences and small definitional understanding. We call it semantic games, where using meanings and all. We are wasting time. Don't worry about it. So principle, you understand that is enough. Principle is, if any amount is remaining unpaid on any shares, is a call. Can I pay dividend or interest on it? You can, provided there is an authorization in the articles, right? Yeah, interest or dividend depends on what the articles is talking about. Suppose you're declaring a dividend, then you can pay on that dividend on calls in advance also. Interest also. See, to the extent that the allotment has not been made, strictly speaking, that is an advance money. It is not part of share capital yet. So you can pay interest also. Okay. Clear. We come to issue of shares at a premium, where the shares are issued at a price above its face value. It is said to be issued at a premium. So premium is difference between whatever the company has received for the share, okay, and the face value of a share, right? That difference is called thing. Just give me 1 minute. I will, my internet as usual. Dealing 5G. I'll connect through this. Yeah, now it will be somewhat better. Correct. Moving on. So I see I have a 5G connection. I'm using that connection now. So stable, it should be more stable is the point. Earlier I was connecting through my mobile car hotspot, which I will now. So wonderful. Now, going on. Shares at a premium. When shares are issued at a premium, the amount of premium received shall be transferred to an account called securities premium account. Now, some of this could be already known to you because you would have studied it in accounting, even at foundation level or at school level. So, known to you. Okay. Oraji, now it should be better. Just confirm that you are able to hear me better now. I'm sure my voice is audible to you now. Yeah. Because in between, I was changing the connectivity. Maybe during that time you missed out. Right? Now I'm sure it should be better. Just some of you kindly confirm that I'm audible and visible and my screen is visible to you and that the slides are moving. Just confirm if you don't know. I know because it is now I'm using a slightly more powerful connectivity. See, whenever we are receiving premium, okay, that money cannot be used to pay dividend. Why? Because it is a capital profit. It is not a revenue profit. This is not a profit derived by running the business of the company. This is a money that you get as a capital appreciation due to the way you ran the business of the company. Therefore, they say that security premium account cannot be used for paying dividend. Dividend should be paid only out of revenue profits generated from the business of the company, not out of securities premium. So securities premium cannot be used for payment of dividend. Then what can I use it for? Thank you. So that gives me some. Securities premium account may be applied by the company only for 5 matters, which I'm sure you know. For the sake of coverage, I'm going through it, but I'm sure you are familiar with this. Okay? Because I'm assuming that you are familiar with this, unless some people have not. Like Kanchana Kumari, I think, may not have. Nothing wrong, but this is a little well known. Okay. If you do not know this, knowing some small difference in meaning of words and all is not important. But these 5 things you should know by heart. You should know what they are and you should be able to remember. Okay. So the 5 matters for which the securities premium may be applied or utilized or used by the company are A, towards issue of unissued shares of the company to the members of the company as fully paid bonus shares. So I have authorized capital, but not yet issued. Now I can issue fully paid bonus shares. So for every person who is holding 2 shares in my company, I will give 1 share, fully paid bonus share out of securities premium I can give. Of course, I can issue bonus shares out of reserves also. But security premium also can be used for issuing fully paid bonus shares. Right? So the entry would be, I already would have credited securities premium account. Now I will debit that and I will credit share capital. That's it. See, bonus will always happen at par. Allotment of bonus shares will always happen at par, right? So no question of valuation and all that. It's at par. So 10 rupees share, 10 rupees. You will get one more share free. It's a bonus. That's why it's called a bonus share. Sir, under circumstances, company can give dividend from capital profit. Harshit Jaswal makes a point, which is good. I will take up this point once I finish these 5 matters. Interesting point. I have one example when this can happen, but otherwise, no. Rule. Dividend can be paid only out of revenue profits generated from the business. Please take it as rather, dividend cannot be issued out of capital. This is a golden rule. Possibly, I may not be teaching dividend, but when you come to dividend, please, it is a golden rule of dividend that dividend cannot be declared out of capital. Let's put it this way. Dividend cannot be issued out of capital. Now, capital profit, whether I can give. Like, you cannot use the capital for declaring dividend. Okay. Also, certain type of capital profits which are relatable to the capital of the company cannot be used for declaring dividend. Okay. But this does not apply to all capital profit. I will come to that. Once I complete this, I'll take that up and then we'll move on. And it's a very relevant point to talk about this because security premium is a capital profit which relates to the shares. Therefore, out of that, you cannot declare dividend. You can only allot fully paid bonus shares. Okay. Also, you can use security premium for writing off preliminary expenses, right? Preliminary expenses. Now, preliminary expenses should normally be taken to the P&L account. Okay. But in case you don't take it to P&L account and you have some, you don't want to reduce the profit, you have some securities premium, you can adjust it in the balance sheet itself instead of taking it to the P&L. In writing off the expenses or the commission paid or discount allowed on any issue of shares or debentures of the company. Now, you cannot issue shares at a discount. You already know that. But you can issue debentures at a discount. And you may pay commission on both shares or debentures. So, these amounts normally should go to the P&L. They will anyway go to the P&L. But if you don't want to take it to the P&L and you have securities premium, capital profit available, you can adjust it. That's the point. In providing for the premium payable on the redemption of any redeemable preference shares or debentures, I'm issuing the preference share at a discount, at par, and I am redeeming it at premium. I'm redeeming it at premium. That premium is a cost. That premium which I will pay at the end of the period, at the time of redemption, will usually be written off over the lifetime of the debentures. You know that. So instead, if you want one shot, you can adjust it against the securities premium account. Okay. One more important point. Later on, we'll be seeing buyback. So if you want to buy back your own shares, if you want to purchase your own shares, if the company wants to buy back its own shares, securities premium account can be utilized for buyback. See, buyback of shares should be done only out of free reserves or securities premium account or the proceeds of a fresh issue. So 3 things can be used. So in your balance sheet on the liability side, if you have profits, general reserve, P&L account, all that, great. To that extent, you can buy back. Suppose you have securities premium account. Yes, to that extent also you can buy back your shares. Okay. Now, so what is buyback and how to buy back contained in section 68. Very much in this chapter. When I come there, I will tell you in more detail. At that time, just link with this and remember that securities premium account can be utilized for buyback. Okay, good. So all this is taught in accounts, so you know it well. Jyoti Jha, I want you to clarify one thing. Are you making a statement or are you asking a question? If there is a question mark at the end, I will answer. If there is no question mark, I will assume that it is a statement. You have to be clear. Either put a question mark or then I will take it as you are part of the faculty team. So you are also teaching us. No, don't do that. Okay. So is it a question or is it a statement? Because generally in English, when you are asking a question, it is customary to put a question mark at the end. Can we follow that discipline? Otherwise, I will think you are making a statement. You are saying capital redemption reserve can used for declared dividend. If you are saying that, I don't know whether it's correct or not. Can capital, and first of all, you are jumping the gun. What is capital redemption reserve? I have not taught. Now, so when I come to redemption of preference shares, at that time I will tell you about capital redemption reserve. At that time I will tell you whether it can be used for declaring dividend. How can a company purchase its own shares? Answer will come when we come to 67, 68. Hold your eagerness to know. It will be my unfortunate duty to tell you, or fortunate duty to tell you, and your unfortunate duty to listen. So when you come to 67, 68, etc., I will tell you about purchase by a company of its own shares and all. Abhinay. But what you need to know, remember, is there is a link between securities premium and buyback. Securities premium can be used for buyback of shares. Okay. Coming back, before we move on to this, see, of course, Rule 3 also says unlisted companies, private companies may apply securities premium account in paying up unissued. Boss, I seriously don't know why this Rule 3 is there. Okay. I don't know why this Rule 3 is there. Because this is anyway there. They say unlisted companies, private companies, and listed companies. Jyotija, if you're asking a question, then put a question mark at the end always. If it is a question, then clear answer. Capital redemption reserve cannot be used for declaring dividend. Answer. It is not a free reserve. It cannot be used for declaring dividend. Idea is you lock up the free reserves. Idea is capital redemption reserve is created for locking up the free reserves so that it will not be available for declaring dividend. Why we do that? When you come to redemption of preference shares, buyback, I will tell you. Okay. Correct. There should always be a question mark at the end of the statement. Okay. Since the language you are using here is English, it should be done in, I'm saying it should be put in 100%. Okay. So, point is good, well stated. I mean, I see this habit by many of you that when you are asking a question, you phrase it as a statement. And I'm getting worried. Is this gentleman or lady advising me, or are they asking a question? So kindly, if you want to make a factual statement or add to the knowledge or give me more information, full stop. But if you want to ask a question, add a question mark there. Forget syntax and all. If you put a question mark, I will treat it as a question. If there is no question mark, I don't know what to say. Okay, now. So this Rule 3 gives some sort of an additional point. That's not additional. Private companies, unlisted companies, and listed companies may apply security in paying up unissued equity shares. All this is already covered in section 52. No need to worry. Don't break your head on this. Nothing. As usual, the Ministry of Corporate Affairs is confusing between rule and section. Okay. Because they've got rule making power, they are simply making some rules and doing all these things. Okay. Very important. Shares, you cannot issue shares at a discount. You cannot issue shares at a discount. Okay. Why? Because I already mentioned, am I correct? In answer to Mr. Harshit Jaswal's question, I said, thou shalt not declare dividend out of capital. It's a commandment. Thou shalt not declare dividend out of capital. Now, suppose I issue shares at a discount. What does it mean? Straight away, upfront, I am giving a dividend to them. It's like when he is buying the share, I am giving him a dividend. In the sense, I am giving him a credit of 10 rupees per share when he is actually giving me only 9 rupees. That 1 rupee is a straight dividend on capital upfront. Even before he is entitled, he is getting 1 rupee. So that is not correct. Therefore, the Companies Act 2013 prohibits issue of shares at discount. That is, issuing a share at a price below its nominal value, it is prohibited. Okay, right? So that is not ours. Now, my dear friends, Harshit Jaiswal's question still remains. Is it possible for a company to give dividend from capital profit? Yes. I will tell you when. One example I'll give you, but note my words. Exactly that circumstance should be there. Only then you can declare. You should have sold an asset at a profit, and the amount should have been received in cash or money. It should be available in the form of funds in your bank account. The profit should be available in specie. It should be available in money with you. That profit, which is realized in cash, what we mean by cash is money. If it is available, you can use it for declaring dividend. It's a capital profit, but it is arising on sale of an asset, whatever. And that money has been realized in cash. And it is available, and it is there for declaration of dividend. In that one case, you can issue dividend out of a capital profit. Otherwise, no. Okay, this is the point. Right? Got it? So, why debentures does not form part of capital structure and why CRR form part of capital structure? See, capital redemption reserve will come under the head shareholders funds. See, in the balance sheet, in your Schedule 3 balance sheet, you will find capital redemption reserve belongs to the shareholders. Except that it is not available for declaring dividend. It is not a free reserve. It belongs to the shareholders. So it will come under shareholders fund. Again, you're using a word capital structure. I don't know what you mean. Do you mean, why CRR is part of, what do you mean by capital structure? Can you redefine capital structure for me? I don't know what you mean by capital structure. Because capital structure is a very big term. Capital structure includes both debt and equity. Debenture is debt. CRR is part of shareholder fund. It will come under reserves. It will come under the heading reserves and surplus. Okay, so it's part of capital structure only. Debenture also part of capital structure. It is debt. It comes under debt. It depends on the definition. It will come under either a current liability or a non-current liability. If it is to be redeemed within the next 12 months, it will become current. If it is beyond 12 months, it will become non-current and it will go there. Now, far be from me, you are all experts in accounting and finance. Far be from me intention to tell you what is correct, wrong. My understanding, my limited understanding is that current and non-current and all that. So, point is, so that is how it is. So, I don't know what you mean by capital structure, but this is what my understanding is. See, what happens now? See, unless I teach redemption of preference shares, you cannot understand CRR. So, why don't you patiently wait for me to come to capital redemption reserve? When I will explain why CRR is created, first of all. You understand? Because you have accounting knowledge, you are jumping the gun and asking the question. There may be people here who don't even know what is capital redemption reserve. Why is it created? I will explain. At that time, 100% I will answer all these questions. Is that a good idea? So, securities premium allowed in writing off, discount allowed. Yeah, discount allowed on issue of shares, not discount allowed in trading. Discount allowed on issue of shares. You can use it. Yeah. That's why I was very careful. Did you notice my words very carefully? When I mentioned discount, I told you cannot issue shares at a discount. Were you listening at that time, Mr. Patsardi? I was very carefully saying you cannot issue shares at a discount. Were you listening at that time? But you can issue debentures at a discount. And you may pay commission on both shares or debentures. That's why the words used here are commission paid or discount allowed on any issue of shares or debentures. There are so many R's there. So, hope you are now clear. Company cannot issue shares. See, do not look for such. We are not so obviously foolish, no, to tell you here something and then change it and tell you something else there. That's why at this time itself I was very carefully telling shares cannot be issued at a discount like that. I know you will ask the question. That is why I am struggling to help you that later on I'll be telling you there's a prohibition like that. One more thing. This is not a blanket prohibition. There are two situations when shares can be issued at a discount. There are two situations when shares can be issued at a discount. Can anybody tell me one at least? This is an open question now. Two circumstances when company can issue shares at a discount. Normal rule, you cannot issue shares at a discount. General rule, company shall not issue shares at a discount. Any share issued by a company at a discount price shall be void. In case you issued at a discount, then you have to refund the amount. In case you have issued at a discount, the allotment is void. The company shall also be liable to refund all the monies received with interest at 12%. Okay. Also, there's a failure if you issue shares at a discount, there is a penalty equal to the amount raised through the issue at a discount, or 5 lakhs, whichever is less. So this is the serious penalty that you have to undergo. Now, having said that, there are 2 circumstances when shares can be issued at discount. Anybody? All the usual wrong answers are coming. Correct. See, you are all more interested in contradicting rather than in learning. Not like that. I think you are all so. So, allow me to give you the knowledge thoroughly so that you will never have any doubt about it. Okay, don't worry. See, very good. So we are coming to the point. Let's see. Dhyanesh, if the company's financial statements are comply with accounting standards, then can company use? Yeah, I think there is a rule that if you want to use the securities premium account, the company's financial statements should comply with the accounting standards. Yeah, only then. In fact, your question should be, should the company's financial statements comply with the accounting standards? Yes, only then you can utilize securities premium account for these 5 purposes. Absolutely correct. Company can issue its shares at a discount to its employees when Alok ji, not for ESOP. ESOP cannot be at a discount, but sweat equity can be at a discount. Piyush is given the right answer. See, Bhaiya, Chetan Bhaiya, don't worry. You can ask question, but if you understand, see what happens now, we are, wasting time. Now, here's a wonderful answer. Piyush Chaurasya, correct. 1 second. I'll come to the point. Those who wrote sweat equity share, you are correct. You can issue share, you can allot sweat equity shares to employees or directors only at a discount. But ESOP cannot be issued at a discount. Be careful. Okay. Sweat equity is different from ESOP. They're totally different. Do not ESOP is not the same as sweat equity. Slight difference. I will be teaching sweat equity very shortly when I will tell you the difference between sweat equity and ESOP. But now understand that sweat equity shares allotted to employees or directors also. Sweat equity shares can be allotted to directors also. Such shares can be allotted at a discount. Okay. One more. Yeah, you are right. Alok is now correcting it. Sweat equity is correct. ESOP, no discount. ESOP, you cannot issue a discount. Okay. You can give it free. For example, you can give it as fully paid up to the employee. You got the point? So that is the thing. Whereas sweat equity shares, you can issue a 10 rupee share at 9 rupees. One more situation is there. Anybody can give me? You gave me one good share. Forfeited shares on reissue. Friends, this is not part of my syllabus. I don't have to talk about it. But since the word forfeited share has come, I'm going to ask you. On reissue of forfeited share, are you giving a discount? Think you'll get the answer. Pranav, when you are reissuing the shares, are you giving a discount? No. Why I'm telling you now? Go back to your journal entries. Are you crediting? See, he is giving 9 rupees, but that 1 rupee is not lost. It's coming out of forfeited shares account, Baba. Already some bakra gave you money. It did not pay the calls. So that you forfeited now. That is a profit you have. That is a capital profit you are having. Out of that capital profit, you are sharing a portion as a concession when you are allotting to the fresh bakra. When you are reissuing to this new bakra, you are telling, Baba, you don't have to pay me 10 rupees, pay me 9 rupees because some other bakra paid me 5 rupees, did not pay another 5 rupees. I have forfeited 5. Out of that 5 forfeited share account, I am giving you 1 rupee here. The balance 4 rupees, I will take it to capital reserve. So it is not a discount. That share capital is going to be coming to me at full 10 rupees. Except that this fellow to whom I am reissuing is not paying that 1 buck. Already somebody has paid. That I am adjusting it here. So technically on reissue, there is no discount. That's what I want to tell. It is a good question arising out of a genuine doubt. I hope Mr. Pranav is now clarified. Thank you. Independent director also, you can allot sweat equity shares. Why not? And I have to be very, very careful. No. Independent director, then he won't be independent anymore. Okay. He won't be independent anymore. If you allot to independent director, you won't be independent anymore. This is a very, very complicated topic, Abdul. When you come to final, we will teach you directors. At that time, we'll discuss this. Too early. There are reasons why independent directors I would not allot sweat equity shares. Are you able to understand? Because he cannot enter into any pecuniary transaction with the company. Okay. So if at all he does any nonsense like this, he would cease to be an independent director. That's all. I'm not saying you cannot allot, but he will cease to be an independent director. If you have understood this much, it is enough for you at this stage. Okay. Sweat equity shares and to creditors in special circumstances. Correct. So what is sweat equity shares? I will tell you shortly when we come to the topic which today, I will tell you. Today I will tell you what is sweat equity shares. Just hold on, I will tell you. Okay. When debt is converted, beautiful. That is the second. So two exceptions are there when shares can be issued at discount. Going back to Mr. Pathsarathy's question, can we write off the share discount? Is it possible to have discount on issue of shares? Yes, it is possible. Though it is prohibited, in these two circumstances, there could be, which securities premium account could be used to write off these discounts. Are you able to understand? But there's a blanket general prohibition with two notable exceptions. The first exception you have all beautifully said. As any exceptional case for shares are never, sir, you cannot issue shares at a discount. Only two exceptions are when you are issuing sweat equity shares. Second, when you have entered into a debt restructuring scheme in accordance with any guidelines, okay, fixed by the Reserve Bank of India. See, the company has borrowed, unable to repay the debt. They will become NPA, non-performing asset. So the bank takes action. Now they go to the reserve, they go to the bank and say, we want restructuring. So they are saying, we owe you 5 crores or 6 crores, 5 crores. Please waive the interest. Totally 6 crores. Waive the interest. Take a haircut. Waive the interest. 1 crore. Balance 5 crore. Instead of asking me to repay, kindly convert it into equity. I will give you shares. Now, the bank will say, chalo, no problem, we will take shares. But I cannot take it at your par value, I say. Give it to me at a discount because that is compensating me for the interest that I'm foregoing. The creditors are entitled to some interest, no, which they are foregoing. So at least if you give this fellow at a discount, then what happens now? He will get more shares. Please understand. If I owe him 5 crore and if I divide by 10, I will get 50 lakhs, let us say. Okay, 10. Okay, if it is 10 rupees per year. Suppose it is, say, I'm giving it at 5 rupees, then he will get double now. So that is a good benefit for him, which may compensate him for the interest. Tomorrow, when the company is actually doing better and the price moves up slightly in the stock market, this fellow will make some money on that. Now, that is to compensate him for the interest that he has foregone now. So in those cases, you can allot shares at a discount. But this is again in accordance with any guidelines or directions or regulations specified by the RBI. Not just like that. See, again, you are using words very loosely. What did he say? Creditors to be converted into share. Now, in the exam, don't write like that. In the exam, please try to write exactly what I have given in this slide here. Okay, when shares are issued as conversion of debt into shares in pursuance of any statutory resolution plan or debt restructuring plan in accordance with guidelines. If you don't want to remember all this, okay, make it sweet and simple. Where debt is converted into shares in pursuance of a debt restructuring scheme under the guidelines issued by Reserve Bank of India. At least that much if you write, you will get more marks. If you write something like creditors to convert it into share, creditors and to share allotted to creditors in special circumstances, you will get marks, but not as much as you think you are entitled. The slight difference between more accurate answer and less accurate answer. Wrong, right, no. Both are right, but more accurate and less accurate. Are you able to understand? So later on, if you say, I wrote the right answer, why I have not got mark? I will say, you have written the right answer, but not exact, accurate answer. Okay. So law paper, you have to be more accurate. The marks are allotted point by point. So that is why. Okay, good. It can be issued at discount to your creditors in pursuance of debt conversion into shares. Again, use the word under any accordance with any guidelines specified by the RBI, Reserve Bank of India. Put that in there. Okay. Logic I have given for your understanding. You need not write it in the exam, but for your understanding, I have given the logic. You need not write it in the exam. Okay. Fantastic. Good. So, discount on issue of shares. Refund. You have to refund the money and all that. Now, Kanchan Kumari, I think, asked the question, right? What is sweat equity share? Let us talk about that now. Sweat equity shares means such equity shares as are issued by a company to its directors or employees. To its directors or employees at a discount or for consideration other than cash for providing their know-how or making available rights in the form of intellectual property rights or value addition by whatever name called. Whatever name called. If I give you two examples, you will understand. I'll give you two examples. One for director, one for employee. First for employee. There is an employee in the company. It's a manufacturing company engaged in manufacturing some industrial component. Now this employee is an MTech and he's an engineer, brilliant engineer. He's been working with us for 5 years. Based on his experience in the process, he has given us a new idea, right in the nature of, it's a more of a know-how or a value addition. What he has done is a value addition. Value addition means he has given an idea by which we are able to save usage of raw material. One of the important primary raw materials we are able to save. So every year on an annual basis, I'm saving 5 crores. I'm saving 5 crores on an annual basis. We are so happy. We call him, we put garland, we reward him. We can even give him a check for 5 lakhs. Nothing wrong. That's hardly 1%. I can give him 5 lakhs check as a sort of a cash award. Instead, what I'm doing, I'm giving him shares. Why? Because I want him to feel an ownership in my company. So I tell him, Baba, you have dropped your sweat for my company. Are you able to understand what means sweat? He has worked. An employee, he has given his sweat. For that, I want to reward you. Here is a share. Take it. Okay. Now, instead of giving it to him at par and asking him for money, we are saying, we'll give it to you at a discount. Take it. Okay. Or even consideration other than cash. And we are giving you. Take it. Enjoy. Okay. And so it is a kind of an incentive for that employee. Or another example. We know that somebody has got a patent. We are a pharma company. We know that Professor Awasthi has got a patent by which, a new corona, medicine he has formulated and he has got a new vaccine. Now we know that if we are able to acquire that patent, we would be far ahead of the market. Therefore, we go to Awasthi and we tell Dr. Awasthi, why don't you kindly give this patent to us? So Awasthi says, yeah, please talk to my lawyers. So the lawyers come and sit, your lawyers sit, all of you talk and you break your head and finally you come to some terms with him. We say, Dr. Awasthi, you will become a director of our company, not independent director, ordinary non-executive director. Ordinary non-executive director. We'll pay you annual fees and all that. We'll pay you compensation, all that. Even we'll give you some remuneration, blah, blah, blah. Plus, for this patent, we will give you amount you are asking. How much is Awasthi asking? He's saying simply cool 100 million, boss. Okay, you negotiated, now 80 million. So you tell him, boss, we'll give you 80 million, no problem, because easily by manufacturing it commercially, we will earn that 80 million over the next 10 years. We have valued your patent, 80 million is okay. But that 80 million, don't ask me in money. I don't have money. Instead, what I will do, I will allot shares. That is also called sweat equity shares. It will be allotted for consideration other than cash. So entry will be patent account debtor to share capital. Are you able to understand? Now, these shares can be also allotted at a discount, but in most cases, they'll be allotted at par, but other than cash. Awasthi is not giving cash. Instead, he is giving me a patent. What he will do, the lawyers all will be there, his lawyer, our lawyer. There will be a clear-cut escrow account where we will allot these shares and we will give to the escrow. The lawyer who is his lawyer will hold it in escrow for him. The minute he assigns the patent to the company, once the assignment is over, the escrow from the escrow account of the lawyer, it will go to his DP account. We have to be so careful because Avasti may run away without transferring the patent. So once the patent is assigned in the favor of the company, immediately the money, the shares will go to him. Of course, he might go for a cash and share deal, by which I can give him $20 million cash and balance, or $30 million cash, balance 50 million shares, something like that. Okay? Whatever it is. Now, I hope I have communicated something to you. This is called sweat equity shares. They may be allotted at a discount. Now, sweat equity shares, if it is a listed company, SEBI guidelines also have to be followed. SEBI guidelines also have to be followed. If it is an unlisted company, it is enough if you comply with section 54 read with rule 8. That's all. Okay. Good. Now the actual or anticipated economic benefits derived or to be derived by the company from an expert or a professional for providing know-how or making available rights in the nature of intellectual property rights. So the actual or anticipated economic benefits. So what we'll do is we'll project the benefit into the future by exploiting the patent, by using the idea given by the employee, how much money will we save in the future, then discount it to today, and so on and so forth, and arrive at an amount. And then instead of giving him money, we give him cash, we give him shares, right? So this is sweat equity share. Harshit Jaiswal says, I've seen many celebrities were charged share in the company in the exchange. Why not? No. Why it won't come under sweat equity? Because you yourself can understand that celebrity is neither a director nor an employee. So strictly speaking, can I call that sweat equity share? No. It is a normal allotment of share to a person for consideration other than cash. Instead of giving money, he is rendering a service as a celebrity. Instead of giving him cash, I am giving him share. That is called issue of share, allotment of shares for consideration other than cash. But suppose the gentleman is a director or an employee, only then you can call it sweat equity shares. I hope I have clarified this point. Here the word employee is also defined. Permanent employee who has been working in India or outside India, director of the company, or employee or director as above of a subsidiary in India or outside India, or of a holding company. Please note, subsidiary can be a foreign subsidiary, but holding company should be in India. Okay. Now, I am not covering ESOP here because it is not in the section, but for the for your benefit, I'm telling, there is a slight difference between sweat equity shares and ESOP shares. ESOPs are a HR initiative. I have it somewhere. I'm not here. ESOP, Employee Stock Option Scheme, is a incentive, is a HR initiative by which we want to give employees a sense of ownership in the company. So what we do, we come out with the ESOP scheme. We prepare the policy document. We appoint an ESOP committee. They prepare the policy document, get it approved by the board, right? What does it involve? We will classify employees based on number of years of service. For example, an employee who has worked for 15 years and above, 1,000 shares. Work for 10 years and above, 500 shares, like that. So it depends on their age, eligibility period. Depend on how long they've been with us, we give them shares. So they'll be entitled to purchase the shares. That right to buy that share is called option. The right to buy the share is called option. So we will give the scheme to the employees, and those employees who are interested will buy the option by paying 1 rupee or something. Then, to that extent, the company will allot the shares to a trust for the benefit of the employee. Later, whenever the employee wants to buy the share, he can surrender the option, means he can enforce the contract and he can purchase the share at a predetermined price. Predetermined price, not a discounted price. Predetermined price means it is not below par, at a predetermined price, which could be below the market value. So he will have the exercise period to do this. So when he sees the market price going up, he will exercise his option and he will get the share. Then there may or may not be a lock-in period, wherein we'll tell him, you cannot sell the share for a certain period. May or may not be. It is not compulsory. May not be there also. Okay. So now the basic difference is sweat equity shares are given to specific employees, whereas ESOPs are given to all employees based on certain criteria. See, once a guy has completed 15 years, even if he's a donkey, you have to give him the ESOP, because this is not based on he giving some know-how or intellectual property. Whereas sweat equity is given to employees only when they provide value addition or intellectual property or know-how. Otherwise, you won't give. So there's a basic difference between sweat equity and ESOP. Sweat equity, I can allot at a discount. ESOP, I cannot allot at a discount. Okay, these are the basic differences between sweat equity shares and ESOP shares. One more important distinction. ESOP can be allotted only to employee directors, directors who are employees. Okay. Whereas sweat equity can be allotted to any director, whether whole time or not. Okay, you can allot to any director. Single sentence. Single sentence only you got it. Sweat equity shares means equity shares which are issued by a company to its directors or employees. See, there's only one full stop at the end. Okay. You want it not in single sentence. You want it in simple terms. Sweat equity shares are shares allotted to employees for providing know-how or intellectual property right. Sweat equity shares are shares allotted to employees or directors for providing know-how or intellectual property rights or value additions. The same thing here. This is all. So basically, I'm allotting shares to employees or directors for providing know-how or IPR or value addition. Okay. This is the best single line I can give you. I have also given you two examples. Did you find them useful? Did they give you a better idea of what is sweat equity? That is why I gave clear-cut practical examples to help you understand how and when sweat equity shares will be allotted. It means an employee who is on wage-based. No, he can be issued sweat equity shares. Why? On wage-based means wage is permanent. No? Permanent. Wage means he is a worker, permanent. Why? How do you say he is on wage-based salary? I think maybe you're talking about piece rate. Even piece rate employees are employees. Please, far be from me any intention to teach you labor law. But even piece rated employees. See, the only thing, time rate and piece rate. You pay him for time, it's time rate employee. You pay him for productivity, piece rate employee. But the relationship employer-employee. Okay, so long as the relationship is employer-employee, he is entitled to sweat equity shares. Your real question should be, can I allot sweat equity shares for a consultant? No, because consultant is not an employee. Okay. Sir, managing director is an employee, sir. The managing director of a company is an employee and also a director. Are you able to understand? MD will have to, there will be a contract of employment between the managing director and the company. Contract of employment. Also, he is a director on the board. So both director and employee. Most whole-time directors are all employees and directors. Whereas non-whole-time directors, non-executive directors are not employees. Okay? They are only directors. So an employee, a director who is an employee is entitled to both sweat equity and also ESOP. And the word employee includes a director. That's all. Sir, any benefit, sir. Any economic or financial benefit. For example, I gave you one example. Did that not give you any idea? He has reduced the consumption of raw material. You are also going to study cost accounting. You will understand only if you understand cost accounting, you will understand the benefit. See, raw material consumption is a cost, right? Whereas earlier I was consuming 50 ton. Now, thanks to this guy's idea. So, okay, value addition is an idea. It's a process idea by which I can save money. Are you able to understand now? Value addition means any idea by which I can save money. So that money saving is a concrete amount now, for which I can reward him by giving him some shares. Ayo, Abdul, proposed director, how he will be included? Yeah. At the time when I am allotting sweat equity share, he should be a director on the board, Baba. These are all two simple things, ma. Don't waste my time asking questions. Use your own brain and answer it. Proposed director means what? A person who is not. That is in prospectus. Told DJ, leave it. Here you think differently. We are only talking about people who are directors. Aaj to today. Only then I can allot. Proposed director means what? I'm going to appoint him. Today he is not a director, na? So don't confuse. See, this is a concept in prospectus. You are unnecessarily mixing it here. Don't do that. There in prospectus, at the time of prospectus, his name was included as proposed director. Subsequently, he would have become a director. Now, are you able to understand? So, proposed director will not be. You have to make him a director only then. In the case of my Dr. Avasti example, till Avasti becomes a director, you cannot allot him the certificate shares, which is why it will be a very, very legal thing. We'll make him a director. We'll allot the shares. The shares will be given to the escrow. It will not be given to Avasti or transferred to Avasti's DP. Avasti has to assign the patent. Then everything will be paka and we will finish it. That is how it is. Okay. Who is a temporary employee? I don't know. Okay, seriously, Pranav, I don't know. Who is a temporary employee? I don't know. Okay, seriously, I'm not able to understand who is a temporary employee. Permanent employees are those who have been working with us. See, basically, I can understand one thing. Suppose somebody, see, we have something called temp staff. See what happens now under the PF Act. My best example I'll give you. Again, I'm giving a practical example. Okay. PF Act. Under the PF Act, if a guy is working for less than 30 days, he's not covered under PF. So what we used to do was we used to have temp staff who would work for less than 30 days. Yeah. They will work for less than 30 days, or was it 90 days? Whatever it is. When they work for less than 30 days, they are not permanent employee. So they would not come under PF criteria. So we used to have temp staff who will be rotated. So one guy will be working for 30 days, then again another 90 days he won't work. Again he'll come and work. Thereby we were avoiding PF for some time. Okay. This was something I have seen large multinationals do. They will outsource the temp staff who will come only for 30 days. There'll be contract. The contractor will bring them again on the exact 29th day. That fellow will be sucked out. He will be given a payment, but only for 29 days he'll be out, and another person will come, and that fellow will have a battalion of people like this who will be rotated, so that no man will work for more than 30 days at a time. He'll go away, 90 days schooling, then again he'll come like that. Such people could be called temporary staff. They're called temp staff. Okay. So this is the best explanation I'm able to give you. Proposed director is an employee today. So, sir, why are you confusing Abdul? If he is an employee, then in employee category, he can be given. You understand what I'm saying? There's a difference. Now, in employee category, he can get, but in director category, he cannot get. That's all. Okay. It's a very, very silly thing. Let's stop this. Huh? Okay. Whatever may be your understanding, it is correct. Let's leave it. He is today not a director. You are telling me that he's an employee. Then as an employee, you allot sweat equity. No problem. No issues. Okay. But he is not a director. Once he becomes a director, only then you can allot as a director. But today, if he's an employee, as an employee, you give him. No problem. Is CFO employee of a company? I don't know. You tell me. You are going to become CFO of a company. Are you an employee or not? You want to be an employee or not? How do you say you are an employee? Who is an employee? The problem is you have not understood principles, and you people are all asking questions without understanding principles. Basic principle involved. There are two types of contracts. Listen to me fully before all your doubts will be resolved with this explanation. Two types of contracts. Contract of personal service, contract for personal service. You are a CFO. You enter into a contract with the company, which means you have to abide by the attendance. You have to abide by the terms of employment. the relationship between you and the company is employer-employee. Then you are contract of personal service. Suppose you are a virtual CFO. You are not bound by the timings. You are not bound by the attendance. You are bound by result. There is a deliverable there and you have to deliver on that. Nobody will question you. Then you are a consultant. Then it is contract for personal service. Even then you have to be present. You are personal presence needed, but you are not bound by the employer-employee relationship. To put it even more differently, if you know income tax, you will understand this better, right? This is 192, that is 194J. Means deduction of TDS here for salary, there for professional fees. Okay, so whether you are an employee or if CFO is employee or not, I will ask a different question. Are they deducting TDS for professional fees or are they deducting for salary? If you're using the salary TDS rule, then he is an employee. If you're using the 10% 184J rule, then he is a non-employee. This is the principle involved. So if you understood this, then you will never have a doubt about who is an employee and who is not an employee. Is CFO employee? If the relationship is employer-employee, he is an employee. If the relationship is consultant, then he is not an employee. For example, today we have virtual CFOs. They are called CFO, but they are not employee. They are consultant. They will be CFO for 3 companies. Okay, doing the job of a CFO, but they won't be an employee of any company. There will be deliverables and all that. It's tougher. It's better to be CFO in one company. But why they do it? Because they think there's some sort of a flexibility there and they make money. So they do it. That's called virtual CFO. Those cases, he would be a non-employee. But you have to come in the morning at 9:30, go at 8:30, you are an employee. Got it? Okay. No. So it's not that I'm not happy with your questions. It's just that you are all eager to ask questions, but you're not willing to think deeply and understand what is being said. For me, it is not a problem. The danger is for you. When your ability to understand is more to ask questions, then you're not clearly learning. Whereas when you are listening to absorb the knowledge and to learn, to an extent, the questions will stop. And only doubts will be there, which we can clarify. But you are confusing yourself with all these questions. Are you able to understand? The subject is a very, very simple subject. It's easily understood, remembered, reproduced. Institute is not interested in asking questions from some nook and corner, from some small areas. They are very clear. They know what is needed, the knowledge that is needed for you, which is what I'm now teaching. So broad knowledge you want. Provided you possess that knowledge, they will clear you. It's only when you start digging into these holes, small holes, and you start asking questions, you are confusing yourself. My humble suggestion, don't do that. Rather, understand the subject broadly, simple things. Remember, go to the exam, write the exam, get 70 marks and go. When life is so simple, why are you making it difficult for yourself? That's all I'm asking. Are you able to understand? Correct. Virtual CFO. Again, I'm saying now, why should I answer your question when the question can be answered only if you tell me what is the relationship? So that is more important. If the relationship is employee-employee. But one more thing, sir. CFO is a key managerial personnel. When he is a key managerial personnel, 100% he will be an employee. Are you able to understand what I'm saying? When he is a key managerial personnel, no company would have a KMP who is not an employee. Okay, no company will have a KMP who is not an employee. So 100% the chances are CFO is a employee. Okay. Some rare cases, virtual CFOs and all will be there. But they are not liable as CFO under the Companies Act. Okay, that's what I'm saying. So please, don't get confused with all this. This subject is a very, very simple subject. If you want to make it complicated, it is in your hands. Making it complicated and confusing is in your hands. Making it simple is what I am trying to do. Hey, come with me. I will make it simple for you. Jnana will be there. Go to the exam, write it. Confuse yourself, you will go mad. Okay? So between you and us, just think like that. Now, some salient points to be noted. Shares to be of a class of shares already issued. Means fresh, you cannot issue shares which are not yet issued. For the first time, you cannot issue as sweat equity shares. authorization should be by special resolution. Mostly you'll find anything to be done in terms of capital, there will be a special resolution to be passed by the company in a general meeting. Listed companies to comply with SEBI regulations. Do you remember what I said? SEBI regulation. Other companies with Rule 8. Okay. Cert equity shares to rank pari passu with other equity shares. Means because they are cert equity shares, they won't get a second class treatment. Pari passu means in proportion or in the same way, in equal footing. Pari passu means in equal footing with other equity shares. So existing equity shares, they will get the same rights, voting right, everything will be the same. No difference between cert equity shares and other equity shares. Okay. The sweat equity shares issued to directors or employees shall be locked in, non-transferable for a period of 3 years from the date of allotment. So sweat equity shares cannot be sold for 3 years. There is a lock-in as per the section. They will be valued at a price determined by a registered valuer at the fair price, giving justification for such valuation. See, we are going to allot the shares of the company. The company is already making profit, etc. So it has a fair value. Suppose it is listed, then SEBI guidelines are there, very clearly determining the value. They will ask you to take the average for the last 6 months or the immediate preceding 21 days, whichever is higher, like that, they will give criteria. Okay. SEBI guidelines are there, not necessary to know now. Maybe when you come to final, it's enough if you know. At this stage, what you should know, the price should be determined by valuation, determined by a registered valuer. Okay. So this is regarding your sweat equity shares. One more point, difference between sweat equity shares and ESOP shares. ESOP shares may not have a lock-in. There may or may not be a lock-in. But sweat equity shares, there is a lock-in of 3 years straight away. Okay. Of course, far be from me any intention to prevent you from asking questions. I'm only asking you to be careful to think through a question before asking it. That is all. If you are having a doubt on a topic, please raise. Or a specific doubt you raise, but don't confuse us. So I hope I have not put you off questions. So kindly keep questions coming. I'm happy with your questions. I'm also giving answers. But when, I get a little worried, you are wasting time asking counter questions. Then counter question. It's a waste of time. Let's not waste your time. Let's go on with our life. That's what I'm saying. Good. Again, I'm assuring you, law is a simple subject. There is no need to get confused in law. You can easily understand law and you can easily score high marks in law. Provided you know the principles and the salient points. Okay. Now, we are first going to see some kind of a classification of preference shares. Why? Because then it will be possible for us to appreciate preference shares better. You already know that preference shares may be cumulative or non-cumulative. Meaning, if they are non-cumulative, in an year of loss, you need not declare dividend on preference shareholders. In an year of loss, when there is no profit, when there is no P&L balance, P&L balance is negative. Below the line, profit for the year is negative. There is no carry forward profit. P&L balance negative. Then you need not declare dividend on non-cumulative preference. But cumulative preference shares, even in a year of loss, you should declare dividend and pay it when the company is making profit. So for cumulative preference shares, the dividend will get accumulated and paid in the year when the company has sufficient funds to pay. Participatory and non-participatory. Okay, one more question from Abdul. Let us finish that and then come. If employee cease to exist after allotting certain equity shares, still this lock-in period continues. Yes, it does. It'll apply to the legal. I told you, the estate. Okay, the estate and the legal heirs who will have to comply. To answer your question straight away. Yes, lock-in will apply to the the estate, and then once the estate is distributed to the legal heirs who get it. It will continue automatically. See, all this, you might say, where is it in the section? It won't be in the section. It is there in the regulations. And if it is not there, don't worry, the company will put it in the offer document. See, the sweat equity shares are, he has to sign now for accepting. There he will say, okay, there I'm taking it under lock-in. So, just because the fellow is dead, the lock-in will not be lifted. Very much there. Sir, that person is not locked. The shares are locked. You understand? The shares are becoming non-transferable. It will be noted in the DP itself. So, it will be lifted only on the expiry of 3 years. Participatory and non-participatory means normally preference shareholders will be paid dividend first. They get priority, preference in payment of dividend. After the preference shareholders have been paid, if there is a profit, equity will get. Now, after paying equity dividend, if something is still left over, participatory preference shareholders will get an additional dividend. For example, normal dividend on preference shares, 12%. Suppose after payment of equity dividend, say at 24% or 28%, if still surplus profit is there, out of that surplus profit, they may be entitled to another 2%. This is called participatory. Preference shares which do not have this right are called non-participatory. Right? Convertible and non-convertible, meaning on the expiry of a certain period, the preference share will get converted into equity. This is called convertible. If such an option is not there, it is called non-convertible. Usually, conversion is an option. The shareholder can either opt to convert or he can opt to not convert. Okay, not convert. Then you have redeemable preference shares, meaning preference shares that have to be redeemed, meaning we have to pay money and take back the preference shares at the end of a certain period. Irredeemable means they will never be redeemed. We need not pay at all. Till the lifetime of the company, the shares will be there. Preference share will be there. Okay. Now, important. No company shall issue irredeemable preference shares. No company shall issue irredeemable preference shares. Okay. A company may issue preference shares redeemable within a period of not exceeding 20 years, subject to Rule 9, which will be seen. So, Rule 9. So, the maximum period for redemption is 20 years. Any preference share should be redeemable within a period of 20 years, not exceeding 20 years. Less than that is allowed, 5 years, 6 years, 10 years. But maximum 20 years, it should be redeemed. If you want to issue preference shares, there should be an authorization in articles. And the issue of preference shares for a period exceeding 20 years, but not exceeding 30 years is provided in respect of infrastructural projects specified in Schedule 6. Schedule 6 contains a list of projects which are infrastructural. In those cases alone, you can exceed 20, but not exceeding 30. Even in those cases, 10% of such preference shares are to be redeemed annually on proportionate basis. Means you are going to redeem it after 30 years. Now, on the expiry of 20 years, you should start redeeming 10% of the preference share every year for the next 10 years till it reaches 30. So, chances are by the time you reach 30, all the preference shares would have been redeemed. Every year would have redeemed 10%, but it's not compulsorily redeemable. If any shareholder wants redemption, up to 10% you can redeem every year. So, suppose many people want redemption, the cap will be 10%. You'll have to stop at 10%. You can use some rule. You can say pro rata we will redeem, or first come first served. It's up to you to use any rule you want. You can fix a cutoff date and say anybody who sends in their application before that date we will redeem up to 10%. If in case there's a over request for redemption, then use pro rata method. So for every 10 debentures to be redeemed, we will redeem 2 debentures. So if you had 50, you will get 2 debentures. For every 10, you will get 2. So for 50, you will get 10. Okay. You can redeem 10 debentures. Something like that. Now, friends, you all love to ask question. No, I'm going to ask you a question. Okay. I'm going to ask a question. Right? You will have to give me an answer. Here in the section 52, it says, in providing for the premium, D, item D, in providing for the premium payable on the redemption of any redeemable preference shares. In providing for the premium payable on the redemption of any redeemable preference shares or of any debentures. Now, my question is this. In case I'm converting preference shares, convertible preference shares, I'm converting preference share. At the time of conversion, I'm converting at a premium. I'm converting preference shares at a premium. Can I use securities premium account for writing off that premium? Are you able to understand the question? The section says redemption. At the time of, if I'm converting a preference share into equity, at the time of conversion, I'm converting at a premium. 100 rupee preference share, I'm converting at 10 rupees premium. No problem. That premium, can I write it off using securities premium account? No, sir, we can't use. Can't use. That's what. You're going by a strict reading of section 52. See, what I did now, as you know, I'm not an expert on company law. I'm a student of company law like you. So, I'm not an authority. I never claim to be an authority on any subject. Whether it is taxation, Ind AS, accounting, finance, law, Bhagavad Gita, whatever it is, I continue to be a astrology, whatever it is, I continue to be a student. I'll be a student till I die. The point I'm making is, who are the expert in company law? Company secretary. So I put this question to company secretaries. This question was asked by a company secretary student, not by a CA student. This question was asked, it's not an original question because, as you know, I'm only capable of giving answers. I'm not capable of asking questions. This question was asked by a, we can use DRR. Debenture redemption reserve. That is what for debentures you mean. Premium payable, no, sir? Yeah, maybe DRR can be used for paying the premium, etc. So don't confuse with DRR. Again, DRR, you're jumping the gun. DRR is going to come later on. And again, Mr. Sunil Kumar, my question, can securities premium account be used? No. So I got a very beautiful answer from one company secretary, which I will share with you. She said, you can use securities premium account for redemption also. This was confirmed by another practicing company secretary. One is both of them were my students. And they confirmed this. What they said was, sir, at the time of conversion, first we will redeem. First there will be a redemption. Then the proceeds of that redemption. See, there will be a redemption. Book entry will be made first. Meaning, preference share capital account debtor to preference shareholders account. At that point in time, there is a redemption. Thereafter, instead of giving him money, we will allot fresh equity share. So, preference shareholder account debtor to equity share capital account. That is conversion. So, they said legally there is a redemption in every conversion. Every conversion is a redemption. Therefore, it can be used. This is the logical conclusion that one company secretary gave me. Most of you have said no. I'm not saying you are wrong. I'm only asking you to think about the explanation given by a company secretary on this. Okay? And that lady also argued on a different front. She said, sir, where there is no specific prohibition in the law, there is a permission. See, this became a debate because company secretaries, they are knowledge oriented. So once I gave this question to them, they started doing research. So she came to me with a Supreme Court decision which said, where there is no specific prohibition, there is a permission. So she said, sir, section talks about it, but there is no prohibition, therefore there is a permission and all. Okay, that's a very twisted argument, but then I think the other point is well taken. Whenever there is a conversion, there is a prior redemption followed by a fresh allotment of equity. Okay, is the point. So if you do it that way, then you can. But if you're going to do it this way, I mean, you can always pass journal entry like this: preference share capital account debtor to equity share capital. Then it's a direct conversion and not a redemption. But if you do it this way, then you can write off. Is the point. So this is, these are views, boss. Once you get advanced knowledge in subjects like law and taxation, you will realize that there is nothing right or wrong. It's only approaches. It's only the way of understanding the subject. As you expand as a professional, you will no longer be interested in right, wrong, black, white. You will be more interested in understanding the subject and appreciating it and keeping ready with your knowledge. Whenever somebody comes, give them solution. So it's only when you get caught in right, wrong arguments that you have to defend yourself. You have to somehow prove that you're right. Thereafter, you will start giving all bullshit. Once you are into understanding subject, all that stops. You are willing to learn continuously. You are willing to share continuously. Sorry, I know sometimes I give this type of bhashan. I give this type of lectures to you. Please don't mistake me for giving this. It's more out of my eagerness to ensure that your understanding of this subject is complete rather than partial. Sir, I cannot answer that question, sir. I don't have an answer for your question. Seek elsewhere. With this, I am closing. I don't have an answer for your question. Okay, because nowhere in the section I am unable to get any clarity. I am unable to give you an answer which says indirect holding is allowed also, but so I don't want to give you an answer. Okay, I have done my best research. I don't have. If you have any answer, kindly help me. Okay, indirect holding. So, யாராவது இருக்காங்களா இல்ல யாரும் இல்லையா? கோகுல் இருக்காரா? கோகுல வந்து வெயிட் பண்ண சொல்லு. கோகுல வந்து இங்க வெயிட் பண்ண சொல்லு. Yeah, sorry, I have somebody to wait for me. Okay. So the point here is, so indirect. Okay, sir. If you want an answer, my view I will tell you. I don't have an answer. My view I will tell you. Indirect holding is not allowed for associate. Got it? My view I am telling you. Don't argue with me now. Don't put in an argument there. I don't want an argument with you, Abhishek. I am giving my view. Indirect holding cannot be considered for associate company. Okay? Directly they should hold. Indirect not allowed. Whereas the holding company, indirect allowed. In subsidiary holding, indirect. Associate company, no. This is my view. You know why I am hesitating to give this as an answer? Because the minute I give it as an answer, you will give an argument. I don't want any more arguments. My view may be a wrong view, but my view. But if you have another view, I am willing to look at that view. But no arguments, please. No statement saying that this is so, that is so. You get what I'm saying, Abhishek ji? So finally, I have given you one answer. But if you think it's not correct, educate me. Give me convincing view. I will change myself immediately and I will follow your view. Are you able to see how I'm working here? I don't have, everybody can teach me. This is what I feel. If you are still stuck on this point and you still want an answer, I give you an answer. Now answer is given. It could be wrong. If you think it's wrong, kindly tell me how. I will learn. If you think my answer is correct, accept it. We'll proceed with our life. What do you say? Good show. If irredeemable preference share cannot issued by company, why it is put in the act? It is not in the act. Irredeemable preference share is a concept. Irredeemable preference shares is a concept. It is not in the act. That is why they are very specifically saying you cannot issue irredeemable preference shares. Okay. You cannot. Concept is there, Baba. When there can be redeemable preference shares, there should be irredeemable preference shares also. Am I correct? Conceptually, it should be there now. But conceptually, irredeemable preference shares are there. There can be shares, preference shares that are never redeemed. But in India, such shares cannot be issued. Got it? See, again, Abdul, this is the type of question I'm saying try to avoid. This is the type of question I'm saying try to avoid. Because this question leads us nowhere. This question leads us nowhere. But are you comfortable with the answer I'm giving, Abdul? Conceptually, you have, in fact, there could be a country where irredeemable preference shares are there, but not in India. Are you able to understand what I'm saying? Certain things could be there conceptually, but in India, it is not allowed. Okay? This is the point. Very clearly, they are telling in the act, you cannot issue irredeemable preference shares. Right? Even to say something should not be done, I should mention it now. Once I mention it, conceptually it is there now. Once I mention it, conceptually it is there, right? So once the concept is there, we are saying it is not possible. That is all. Now, very, very important. Preference shares are to be redeemed out of the profits of the company, which would otherwise be available for dividend. Preference shares are to be, before somebody is asking for break, I will tell you now, we are going to break at 7:45. We will be breaking at 7:45. Okay, so hold on till then. Usually Suprada ji would be here. She is not at all seen today. Usually she will be asking for break. So she is not reporting. No question from her. So 7:45 break. So preference shares are to be redeemed out of the profits of the company, which would otherwise be available for dividend. So only free reserves are available for dividend. Free reserves are those reserves which are available. So free reserves are those reserves which are available for declaration of dividend. So the redemption of preference shares is possible only out of free reserves, profits of the company which would otherwise be available for dividend. For example, general reserve available for declaring dividend. P&L account, balance in the profit and loss account available for declaring dividend. Dividend equalization reserve meant for payment of dividend, therefore available. Got it. Capital redemption reserve not available for dividend. Right? Debenture redemption reserve not available for paying dividend. Okay. Under the Income Tax Act, okay, you have the Special Economic Zone exemption. Am I correct? 10 AAA exemption is there. Where when you claim that exemption, you have to create a statutory reserve and transfer the amount claimed as exempted profit to that account, which is called a Special Economic Zone Development Reserve or something like that. You might be knowing better than me. So that reserve is called a statutory reserve. That should be kept for 10 years. Then it can be again reversed back. Okay. So till such time that reserve is not available for declaring dividend. Whenever they want you to lock up in some dividend like CRR or some reserve, the intention of the law is that money should be not available for declaring dividend. It should become part of the permanent capital of the company. So that those reserves which are available for dividend can be used for redeeming preference shares. Okay. 10 AA, whatever. The proceeds of a fresh issue of shares made for the purposes of such redemption. So suppose I do not have profits. I want to redeem preference shares. Preference shares can be redeemed only out of profits. I don't have accumulated profits. What do I do? Then the law says, don't worry. You issue fresh shares. Out of the proceeds of fresh issue of shares, you can redeem your preference shares. Okay. So when preference shares are redeemed, there will be a diminution. Diminution means reduction. Diminution. Sorry, spelling is wrong. Diminution. It's not diminution. I'll change that. See, that's what happened. Now I already shared. See, Suprada wanted me to share the PowerPoint. I shared. Today she is not to be seen. Not to be seen means not to be heard there. Anyway, so when preference shares are redeemed, there will be a diminution in the permanent capital. Meaning, to that extent, the capital will be depleted. Therefore, they say, you transfer some of your free reserves to permanent capital. This should be replaced. How? You convert the free reserves and transfer it to an account called Capital Redemption Reserve. Thereafter, it is not available for declaring dividend. But you can issue fully paid up bonus shares out of CRR. CRR can be used for issuing fully paid up bonus shares. Because nothing wrong now. From CRR, it's not going back to free reserve. It can go into further permanent capital. Like it can get into equity. You can allot bonus shares. Nothing wrong. But it should not come back to free reserve. Once gone into CRR, that's it. It's locked. Okay. Suppose I don't have profits sufficient. Then they say, get some more new people, create more permanent capital, issue fresh shares. Make that permanent capital, then replace this permanent capital. So if you want to pay this permanent capital, create new permanent capital. Both options can be adopted, partly out of profits and partly out of fresh issue. The idea is there should be no diminution in the permanent capital post redemption of preference shares. This is the principle that is operating here. Also, if you want to, SEZ reinvestment reserve account. Thank you. Really great. Conditions for redemption. Preference shares to be fully paid. Authorization by special resolution. Blah. Nominal value of preference shares to be transferred to capital redemption reserve. Nominal value of preference shares redeemed to be transferred to capital redemption reserve. Why nominal value? Only to that extent there's a depletion, right? So I have to transfer only the nominal value. The premium need not be transferred. Why? Because any premium on redemption can be set off against security premium account. Am I correct? Or you can write it off in your P&L account. But the nominal value should be transferred to the permanent capital. CRR not to be utilized for payment of dividend, but may be utilized for issue of bonuses. Friends, I have a question for you. Supradaji, welcome. Nominal and face value same. Nominal, face value same. Okay. Both are same. Nominal value, face value same. I have a question for you. Give me the answer. Diminution means reduction. Diminution. See, you are also spelling it wrongly. Sorry. I'll first change it. I'll first change that spelling. I feel ashamed that I have made a wrong spelling. Maybe it was a typo. Diminution. Diminution means, listen to me. Somebody was asking about diminution. Listen to me. Sushil Kumar Barik. Diminution means reduction. So read now using reduction, same meaning. There will be a reduction in the permanent. So why are we using the word diminution? Because we know English. Because we want to show off our English. That's all. Sorry. Why can't we use simple words? We want to confuse. So we use. That's all. Nothing else. Okay. Diminution means reduction. So you have the answer. Almost everybody except you have told A. No problem. Yes, you're absolutely correct. See, the basic point we are trying to make here, I know this is a silly question for a set of CA intermediate students of CA Institute, but still, I want to make it very clear to you that, right, the premium which is payable on redemption and the premium collected at the time of acquiring the equity share should not be considered. So, you are going to issue 1,500 equity shares of rupees 100 each at a premium of 20%. Now, for the purpose of calculating, we should only take the 100 rupees and not the premium, because the premium that you collect will go to securities premium account, and that cannot be used for redeeming preference shares. The 20% premium that you're collecting cannot be used for redeeming preference shares. It can be used only for the 5 purposes. Are you able to understand? Maybe the premium that you're paying on redemption of preference share, that can be adjusted out of that 20% that you're collecting as security premium. But you should take only the nominal value. If you reduce 1,50,000, the balance 50,000 will have to be collected by way of out of profits. Okay. Now reverse question. Similar reverse question. This is a reverse question. I think the answer is very simple. I'm sure all of you are going to quickly give the yes. Yeah. Now, so Ajay Limited decided to redeem 10,000 preference shares of rupees 10 each at 10% premium. Balance in P&L account is 60. Securities premium is 10. Can I consider securities premium? No, I cannot. Securities premium can be used only for writing off the 5 matters, right? So ignore it. So that means 1 lakh minus 60, 40. 40. Now I'm issuing the fresh equity at premium. I cannot consider. Only the nominal value has to be taken. Okay. Now, to the extent of 60,000, it will be transferred to the CRR. The amount that I'm utilizing for redemption out of profits, to that extent, you have to transfer to the CRR. Okay. You have to transfer to the CRR. And sir, that amount paid up of equity and only is to be considered for calculating CRR. Language not clear. In this example, what is the amount to be transferred to CRR? The amount redeemed out of profits only, which is 60,000. That has to be transferred to CRR. So the entry you will pass is P&L account data to capital redemption reserve 60,000. Okay, that's all. Balance is that balance 40,000 is out of fresh issue. That will be not transferred to CRR. No transfer to CRR. In this example, 50,000 will be the amount transferred to CRR because that is the amount you're going to utilize from profits. The amount that you're utilizing from profits only will have to transfer to CRR. Got it? Correct. Correct. How did you get C is something that you might want to ask yourself. Paid up amount is to be considered for calculating CRR. The difference between face value or paid up share capital. And see, for calculating CRR, you should only consider the face value. You should not. For example, when you're redeeming the preference shares, the amount that you will be paying to the preference shareholder is 10,000 into 10, 1 lakh plus 10%, 1 lakh 10,000. For transfer to CRR, you will consider only 1 lakh, which is the face value, minus the amount you are utilizing. This 60,000 will go to CRR. Balance 40,000 will come out of the proceeds of a fresh issue. The 10,000 that you are collecting, that you are redeeming as a premium, that is going to be either written off to P&L or you are anyway collecting securities premium on issue of shares. That premium can be used for writing off this premium on redemption if you want. Okay. Mr. Abdul, maybe you are not listening to the lecture at all. You are more interested in countering and asking questions. Don't do that. Listen, you have to transfer the go back. Nominal value of preference shares redeemed to be transferred to CRR. Now, out of profits, to the extent that it is out of profits, you have to transfer it to CRR. That is why I gave an elaborate explanation on why CRR, etc., etc. So permanent capital. That's why I gave this elaborate explanation. Listen carefully. All your doubts are out. Okay. Only when you're doing imperfect listening and asking questions and countering, you are unnecessarily wasting everybody's time. Think about it, Abdul. Think about it. You have to transfer the nominal value of the shares redeemed out of profits. So what is that? Out of 1 lakh preference shares, 1 lakh, 60,000 is out of P&L. That is out of profits. To that extent, I have to transfer to CRR. The premium that I'm getting, you want to debit premium on, did I say that? Because you want to debit premium on redemption in P&L. So after deducting it, it means, no. Current year's profit and loss. That will come later. This year, this 60,000 is already available. First, that will be adjusted for this. Then this premium will be there now. This premium, if you want, you can adjust it against the security, or else it will be reduced in the current year's profit. Are you able to understand? Current profit, not from the accumulated profit. Current profit. The accumulated profit to that. If you're going to do that, see, if you're going to do that, then your answer will be different. Your answer will be 5,000. But my suggestion, no. Currently, you will use the entire 60,000. The balance will be there. If you want to write off the premium, you can use this security premium you are collecting, ideally, or else you have to transfer it to current year's P&L account, out of the current year's profit, which is not yet gone to the accumulated profit. Okay. So that is the answer. So I think you are justifying B. You are justifying B. Agreed. See, the beauty of MCQ is there is only one correct answer. There is no way you can justify any answer. You are either right or wrong. That's all. If you are able to understand why how you are getting 4,000, your knowledge will improve. Otherwise, you cannot argue with the institute. Suppose this comes in the exam and you write B, you won't get marks. That's all. You understand what I'm saying? So understand why I'm saying it's A and why many people are saying it is A. Many people are saying it is A. Why? Because this is all convoluted logic. That 60,000, first I will reduce 10,000. No. First, that 60,000 will be fully utilized. The balance 40,000, I'll issue fresh shares. Now, that premium I'm collecting is either you can use this equity premium or at the end of the year, if nothing is there, you will transfer it at the end of the year to the current year's P&L. Are you able to understand, Abdul? Premium on redemption is not considered because that can be written for what? No. Amount, see, I'm only, the nominal value only is being redeemed. So only that has to be considered. Premium should not be considered. Only the nominal, we saw that, no? Nominal value of preference shares redeemed to be transferred. Actually, I should add a point here, which I will do now. See, to give it little more clarity, I thought you are all aware of it, but since you are having some doubts, I'll put it. Nominal value of preference shares redeemed out of profits to be transferred to capital insurance. I think that point would be, make it clear. So to the extent of, I think the nominal value alone should be considered. That is why I gave you this elaborate explanation. Okay. So that you have to do it. Fantastic. Preference share capital 10,000, issued 1,000 at 10 equity shares and called and paid up 1,000 CRR equal to 2,000. Not able to understand anything. Okay. So this is how it should be understood. Right? So how do you get, Sushilji, how do you get 3333? Maybe you are considering the 20% premium, right? That could be why you are looking at 3333. Whatever. Okay. See, the problem with MCQ is there is no way you can justify your answer. Or if you are wrong, you are wrong. That's it. Right? So that is why you should prefer not to have MCQ, but rather have descriptive. At least in descriptive, to an extent, if you are right, to that extent you will get marks. Chalo. Now, suppose a company, okay, now it's 7:45. Let me call for a small break, 5 minutes as usual. Then we'll again come and continue our discussions on issue and redemption of preference shares. Okay. So small break, sir. Welcome back from a well-deserved break, and I hope you use this time. We have Muhammad Aslam again coming in. PSC, what is that? 10,000 and issued 1,000 at 10 equity shares, but called 1,000 at 8 only in this year. And it is written that only the proceeds of fresh issue. Proceeds include 8,000 only. Yeah, proceeds would be only 8,000 because the amount has been received only to the extent of 8,000, not to the extent of 2,000. So balance will be transferred out of profits. Profit should be there. Okay, one. But again, practically, Mr. Muhammad Aslam, practically, only in your question, this type of things will happen. In reality, no company will do things like this. They will issue fully paid up shares only. They will not issue partly paid shares and all. Okay. So only when you're asking questions like this type of doubt will happen. In reality, it will never happen. No company will ever issue partly paid shares or redeeming preference shares. If somebody is proposing, I'm sure some intelligent chartered accountant like you or me will be there to advise them. Please do not do this. Issue fully paid shares. Okay. So don't complicate. Don't create complication where there is no complication. Because this is your decision now. It is a board decision. Why are you issuing partly paid shares and getting confused? Issue fully paid shares. What is it? Mostly it will be issued at a premium only. Rarely for this purpose they will issue partly paid shares. So, though of course your logic is correct, your assumption is correct, your CRR 2000 is correct. I'm not questioning your logic or your intelligence, but I'm saying this is convoluted, confusing. Such thing in reality it will never happen. Practically it will never happen. Okay, is the one. See, I'll tell you, in those days there used to be partnership problems and all. When I studied, I'm sure it is still there. And there, they will have all sorts of things like gaining ratio will be there. 1/18, 1/24 and all they'll have. Only in R.L. Gupta, Radhaswamy or Shukla and Graval, T.S. Graval, you will find gaining ratios will be 1/23, 1/24 and all. Okay. Suppose a client comes to me and wants all that, I'll say, no way. This is what you're going to do. Okay. No, like that. Only in textbook, all sorts of complicated problems will be there. In real life, 35 years of practice, I've never seen such complicated admission of partnership or retirement of partnership. Fairly simple. Okay. The ratios are fairly simple, easy to calculate. We calculate. But only in the textbook, you'll find all sorts of complicated things are there. Today, Institute is also waken up to this fact. They also don't unnecessarily complicate. They expect you to know the subject. That's all. Jnanesh Shingle asked a very good question. Is it necessary to have deep knowledge of Companies Act? Should a practicing chartered accountant have deep knowledge? I don't know what he means by deep knowledge. You should have sufficient working knowledge. You should not be ignorant of company law. Minimum, what I'm now teaching, what you learn in final, compulsory. That is why Institute has prescribed the syllabus clearly, and that syllabus is compulsory. If you don't know that, chances are you may not be able to perform your role as a practicing CA completely. Deep knowledge may not be needed. Means every form, everything, but broad knowledge needed. Okay, is what I would say. Capital redemption reserve can be used for issuing bonus shares. If that's what you're trying to say. Yeah. So coming back to section 55, we've already seen rules for redemption of preference shares and all that. Now coming to the point. Where a company's failure in payment of or repayment, where a company is unable to redeem preference shares or pay preference dividend. Pay dividend here means pay preference dividend. So where a company does not redeem preference shares or pay the dividend, then see, they know very well they don't have the money to pay, right? See, when the profits are there, when fresh issue is possible, you can redeem, Baba. But I have no profits. I have issued preference shares. I have to redeem them. I have no profits. I'm unable to issue fresh issue. How to redeem? So I go to the preference shares. You can obtain the consent of 3/4 in value of the preference shareholders. Here it is 3/4. This is not special resolution. You have to obtain the consent of 3/4, meaning you have to send a circular to all of them saying, we are sorry, redemption is coming up in the next 6 months. We are not in a position to redeem. Also, we are not able to pay preference dividend, as you know. Okay, kindly consent to extension of time or kindly consent to reissue for further period. Okay, whatever it is. Now, once they obtain the consent of 3/4 in value, then they have to file an application to the tribunal and get approval of the tribunal. Once the tribunal approves it, then they can issue further redeemable preference shares so what happens is these preference shares will be closed and fresh preference shares will be, redeemable preference shares will be issued for a fresh period. Extension, almost like extension. Any dissenting preference shareholders are there, they have to be paid immediately. Okay. The unredeemed preference shares shall be deemed to have been redeemed. Okay. Now, suppose preference shareholders have not consented, then the tribunal shall, while giving approval, order the redemption forthwith of the preference shares held by them. So, if you are able to get 3/4, the remaining 1/4 who have not consented, they are dissenting. Dissenting means those who have not agreed, those who have not consented are called dissenting. So, those dissenting shareholders, preference shareholders, you have to redeem fully. Okay. Now, my dear friends, suppose that is also not happening. Then this company is in deep shit. It's a financially unsound company. If you don't go there, please don't even ask me that question. I'll tell you. If they are not able to pay to these buggers, that company will be wound up. That's all, matter over. That company has no business to exist. Either already creditors or even these preference shareholders who have gone to the preference shareholder cannot go to IBCC, but they can hold a meeting and propose the winding up of the company. Okay? Because at least if the company is wound up, the assets will be sold and they'll get something out of it. So this is quickly they'll be getting into winding up only. But if at all you can salvage, for example, I have some money, I'm getting 3/4 consent, balance 1/4, they have not given the consent. I say, come on, take the money and go. At least now I can run the company. Using the balance cash flow, I can run the company, make profit in future, and out of that profit, I will redeem the preference share. So the idea is to revive the company and to help the company to run. Okay. Since this decision cannot be taken by the company alone, they say, you get 3/4 value of the preference shares to consent, come to me, I will examine whether everything is in order and in genuine, then the tribunal pass the order, then you can issue further redeemable preference shares. Thereby, the unredeemed preference shares will be deemed to have been redeemed. If any dissenting fellows are there, you pay them. This is how it is. IBCC, Insolvency Board, the Board for Insolvency, IBCC, Insolvency Board, where the same tribunal, see, if you are a creditor and you have not been paid your money, you can approach the IBC, the Insolvency Board, and you can ask them to pass an order for insolvency. So the board will, IBBC actually, if I remember right, IBBC, okay? So that they will pass an order by which they will say this company is now insolvent. Immediately a resolution professional will be appointed. He will take over the company. He will run the company. He will sell the assets. He will pay the creditors, resolve the whole matter. And then if the company can continue, he will hand it over back. Or else he may go for winding up also. Okay? That's the point. This is for your information. Deemed to have been redeemed means, see, technically, we have made it redeemable within 7 years, let us say. On the end of 7th year, I have to redeem now. I don't have money to redeem. They are consenting, which means I will again issue another set of redeemable preference shares, maybe redeemable 5 years later. So they have to wait for 5 years. And at the end of the 5th year, we hope to make money, profits, or become viable, maybe issue fresh issue. And somehow we'll pay them within 5 years. I have convinced them. See, the idea is you should convince them that how to obtain consent. Yeah, you have to convince them. See, we are sincere. We are not able to redeem. We will redeem. Give us time. Allow us to issue further. So this is how you have to convince the. No, they will be paid. The intention is that they won't not be paid. Postponing it a little bit. Friends, once you become chartered accountant, this is the job you will be doing in and out. Finance. Okay? Getting time. Getting some relief. So on and so forth. Going to the bank. This is what you will be doing. The pressure of your job will involve only mainly this. Okay, going to the bank, getting the check passed, getting finance, cash flow, running, making the company viable. So we have finished sort of issue of shares and share capital and all that. Now we come to another topic called transfer and transmission. 1 second. If the whereabouts of preference holders are not known, their last known addresses will be there. No? At the time of application, they would have given an address, right? And an email ID and all. One more. So that address you send it. That's all. See, for example, I'm sending the consent letter. I'm sending it to the last known address. If that fellow is not there, then he is not a dissenting fellow. He has not consented. So you should be lucky enough to get consent from at least 3/4 in value of the preference shareholders. If you have not got it, then you are in trouble. You have violated the law. You are not redeeming preference shares. Okay. Be prepared to face the consequences. At least get hold of 3/4 of the guy to consent. Somehow find them and get them. Okay. Now, there are two words that we use here. Transfer and transmission. We have been using these words in the past classes without properly giving you a definition. Now, I have the opportunity to tell you exactly what is transfer and what is transmission. These terms are not synonymous. They are not having the same meaning. Transfer means change in, insolvency and bankruptcy code, correct. Sir, you are all great people, sir. Immediately you will go to Google and get me the answer. Thank you. So, basically it's insolvency court. Okay, board for insolvency. No. Basically it's a tribunal. The tribunal plays the same role. The National Complaint Law Tribunal plays the same role. It's also the board for insolvency and resolution. Okay. Transfer means change in ownership of shares through sale, exchange, acquisition, etc. Sale, exchange, acquisition, etc. Ownership of shares is transferred by sale, exchange, acquisition. Means it is by act of parties. It is by act of party. So I decide to sell to you, or you decide to sell to me, or we exchange our shares. Whatever. It is called transfer. Act of parties. It is evidenced by instrument of transfer. Instrument of transfer may sometimes be abbreviated as IOT. Suppose you find IOT, please do not get confused. It is instrument of transfer, right? Transmission means change in the ownership of shares due to death, insanity, insolvency, etc. It's not transfer. It is called transmission. When Mr. A dies, the shares will vest in his estate. Please understand first. It will not automatically go to his legal heir. Automatically, it will not be registered in, because company does not know who is the legal heir. So the estate will be having it. If you inform death, immediately they will freeze it and they'll wait for the owner to come and claim. So then it is the duty of the legal heirs to send proof of death certificate, proof of legal heirship. They might have to give an indemnity bond, and they will have to give some sort of an affidavit stating that they are that, all sorts of proof. In some cases, they might even have to go to the court and get what is known as succession certificate. And that has to be proved. Some different companies have different rules. The articles of association provide for the rules. Whatever the article says have to be followed. Idea is the company will protect itself from wrongful claim. Similarly for insanity. See, suppose somebody is becoming senile, old Buddha hai. So Buddha ho gaya. Therefore what happens? He's going mad. So his son will say, no more, this fellow should control. So he will go to court and file a petition for declaring this gentleman as insane, unsound mind. So the court will call him to the court. They'll take, usually they will take medical certificate. So a psychiatrist will come and he will talk to the gentleman. There are some standard tests and he will say, sir, he is senile dementia, not capable of clarity, clear thinking. so insane. Immediately the court will pass an order saying, so-and-so is found to be of unsound mind. And that same order, they will say, all his assets and businesses will now vest with so-and-so. Usually a relative, son, daughter, wife, somebody will take over. And that person will then run on behalf of the insane person. No, so that we have to register that, that has to be recorded. No? That is called transmission. Similarly, when there is an insolvency, Mr. A is unable to pay his debts. Then we file for insolvency. The court passes an order of insolvency. Immediately they will appoint a receiver or assignee. Okay? That receiver or assignee will then take over the business of the insolvent. All the assets will now vest with the receiver or assignee, including any shares. Suppose any shares are there belonging to the insolvent, that will now vest with the official receiver or assignee. Now this official receiver or assignee, he should send a copy of the court order, proof of document, say everything and send it to the company and say, I am the receiver or assignee. Kindly note in your record that the shares are now vesting in me. The company. This is called transmission. Change in ownership due to death, insanity, insolvency, etc. Any method by which, not by act of parties. Okay, it is called transmission of shares. Okay. Thank you, Mr. Akash Singh. Once in a while, when I hear words like this, I'm happy. Instead of only questions, I'm getting, and instead of only Muhammad Aslam's comments, I'm getting somebody telling your teaching technique is excellent. Thank you. Okay. Insanity equal to insurance equal to indemnity. I don't know. Indemnity is given in insurance also. See, don't confuse. Insurance is also a contract of indemnity. Here, this indemnity is given to protect the company. Are you able to understand? Because they are going to do something by which tomorrow, suppose a new man comes and says, I am the legal heir, then the company will be in trouble. So they are saying, look here, we will go by you. In case somebody comes and claims, then you have to bear our loss. If he is claiming damages, you pay it. If you agree to that, if you give me an indemnity bond, then I will transmit it in your name. So usually they will take some indemnity bond. Also public notice will have to be given in the newspaper to say that so-and-so is dead. These shares are going to be transmitted to so-and-so who is the legal heir. Anybody having objection can come to the company and claim. So that will be there for 30 days. Only after the expiry of 30 days from the date of advertisement, the company will go for transmission. All sorts of precautions will be taken, like legal heirship certificate, succession certificate, which is an order of the court, okay, giving clearly how the assets are to be done, including these shares. Then automatically that succession certificate is enough, wherein they are clearly mentioned, so-and-so, so-and-so, so-and-so are the legal heirs. They are entitled to the following, A to so much, B to so much, C to so much. So if A's name is there and he is entitled to these shares, transmit. So that is how it should be done. Okay. So both transfer and transmission are there. Transfer is by act of parties. Transmission is where the shares of a company change in ownership due to death or insanity or insolvency, etc. Can I say that if the transfer is not in capacity transfer and transfer, don't give new definitions where I have given very clear definition. When I have given a definition, why do you want new definitions? Is this definition not clear? Transmission means change in ownership of shares of a company due to death, insanity, insolvency. It happens by operation of law or on the occurrence of an event. Whereas transfer means parties on their own voluntarily, they want to change the ownership. It happens by act of parties. Okay. When clarity is already there, don't try to create more clarity and thereby confuse yourself. Are you able to understand? So you cannot say what you're saying. You prefer to say what I have told here. If you have a doubt in that, ask me, I'll again clarify. Okay. So I don't want to agree with that wordings that you are given there. You are linking it with Contract Act and you are seeing that these are all examples of incapacity to contract. And therefore, you are trying to link it there and give this definition. Abhishek ji, don't do that. I have given clearly what it is. Where there is an event occurring, because of that event, there is a change in the ownership. That is called transmission. That event could be death, that event could be insanity, that event could be insolvency. Okay. Transfer means no event. Parties decide to transfer. Volition. By act of party, it happens. Okay. That's it. Okay. Transmission happens very rarely. Transfer regularly. Because especially in online trading and online in listed companies listed on the NSE and BSE, there will be millions of transfers happening continuously. Once the market opens, transfer. All that will be collected by the various depositories and informed to the company. So 98% of these type of transactions only transfer. Transmission rare. Only on death it will happen. Insanity even rare. So the total insanity transmission cases in India would be numbered in 10,000, less than 10,000. Okay. Insolvency. Mostly death will be there. Okay. So that is called transmission. You know why sometimes I have to be a little blunt while answering some of your questions. No, people like Abhishek or Abdul or even my friend Mohammed Aslam may get a little upset with the way I'm being bluntly saying, don't do that, don't say that. Why? Because I want you to use the words I'm using in my slides. Because these words have been carefully selected by me and put. Not because that is better than what you're saying, but because these are more precise definitions of what's happening. So kindly do not try to use your own language and get into trouble. That's all I'm saying. Okay. Liquidation. Sir, liquidation is for companies, sir. This is for individual insolvency. Yeah, of course. Suppose a company goes in, that's why that etc. is there. Suppose a company is owning shares in another company. The company is owning shares in another company. Suppose this company is going into liquidation. A Limited is holding shares in B Limited. A Limited, which is the owner of the shares of B Limited, is going into liquidation. Tell me one thing. Will there be a transmission of shares in favor of the liquidator? Answer the question. Will there be a transmission? A Limited is going into liquidation. Liquidator has been appointed. Company going into liquidation, liquidator has been appointed. The shares of B Limited held by A Limited, will they be transmitted to the liquidator? I want an answer. Absalam is saying yes, sir. Yes, for what? Will there be a transmission in favor of the liquidator? See, again, deep knowledge, not deep knowledge. Again, you are not understanding the principles involved. When a company goes into liquidation, will the separate legal entity be changed? Will the separate legal entityship of the company be changed? No. The company is still a separate legal entity capable of holding its shares in its own name. Why should there be a transmission to the liquidator? Instead of the directors, now the liquidator will control. That's all. If the shares are to be sold, they usually transfer of shares by a company, it will be evidenced by signature in the instrument of transfer by an authorized director or even company secretary. In this case, the liquidator will sign. That's all. But the owner of the shares continues to be the company. There will be no transmission in favor of liquidator. But when an individual becomes insolvent, then there will be a vesting of these shares in the name of the receiver or assignee. Okay. There will be no transmission when there is a liquidation. Because separate legal entityship continues till the end. Till the company is dissolved, the company is a separate legal entity. Those shares will be sold by the company, but instead of director, now the sale will be affected by the liquidator. That is all. Okay. So this is the principle that you have to understand. Okay. Good show. Now, the transfer and transmission of shares. The format for the instrument of transfer is SH4. Okay, SH4. Shares, share transfer, share capital. So SH4. It should be duly stamped, dated, and executed. See, the value of stamp to be fixed is given in the Central Stamp Act. It's a central, the stamp duty payable on transfer of shares is governed by central government. And they fix that stamp duty. But of course, stamping will be there only for transfer of physical share certificates. Where shares are held in physical form only, there will be stamp. Where they are held in Electronic form, fungible form, no stamping, no stamp duty, nothing. Okay. The form SH4 is only for physical certificates. For when you are holding it in the form of a depository, DP account, no need for any form game and all. Simply online. In fact, you would have given a power of attorney to your broker. Broker will automatically transfer it. Otherwise, you will have to issue what is known as a depository advice in favor of the buyer. Okay. That will be presented by your DP to that DP, who in turn will send it to the depository and transfer will happen. Okay, automatically. Only for physical certificates, there is a question of SH4, stamping and all that stuff. Are you able to understand? That SH4 should contain the name, address and occupation, if any, of the transferee. Right, sir? And it should be delivered to the company within 60 days from the date of execution. So once it is executed, that SH4 should be delivered to the company within 60 days date of execution. Okay. Which is why sometimes when people come to me and we are planning some transfer of shares and all that, we can predate, but we can't predate before 60 days or maximum 50 days because I need that time. Beyond that, it will not be valid. So now your time of predating is now led to 60 days. Can't go beyond. Legal heirship certificate means, Kavita ji, Mr. A is died. Okay. Then who will inherit his property? His legal heirs. So there is something called Succession Act. Under the Succession Act, the local tahsildar or the revenue authorities, sub-register office, you go there, they will give you what is known as a legal heirship certificate. You have to produce a death certificate. Then they will see the ration card or some other proof to see who are the children, then everybody will be. Wife is the first level. Parents will be there. Parents are legal heirs. Wife, first level. Children, okay. Then brothers and sisters, like that. That is how the legal heirs order will come. That is given in what is known as a Succession Act, Indian Succession Act. Under that, they will issue a certificate. It says, so-and-so died on such and such a date. It is hereby certified that the following are the legal heirs. They give the names of the legal heirs. That is called legal heirship certificate. It should be obtained the minute when somebody dies. You should obtain that legal heirship certificate from suppose wherever he lived, you have to go to the local tahsildar and get the revenue authorities are there, local revenue authorities, state government car. There you have to go and get the thing. Legal heir is different from legal representatives. Legal heir means by virtue of blood relationship, they will become entitled to the assets. Legal representative could be anybody. Okay. Whoever is representing him will become a legal representative. It's slight difference. Legal heir is blood relative. Whose relative they become, they will be legal heir. Okay. Legal representative is slightly different. Okay. Still. Legal heirs are all legal representatives, but all legal representatives may not be legal heir. Okay. I'll tell you one example. A firm is converted into a company. Now, the firm becomes the legal representative, the company becomes the legal representative of the firm. Wherever earlier the firm had entered into a contract, now that contract will now come to the company on takeover. It will become the legal representative. Whereas legal heir is different. Only relatives who are, like I told you, parents, wife, children, brothers and sisters. These are all first level. If none of them is there, then second level will come. So grandchildren, nephew, all will come later. First level, father, mother, wife. Father, mother not there, wife is also not there, then children. Like that. Children all both male and female. Daughters are also legal heirs. They will come. Okay. Now, see, normally, when the company allots shares in physical form, the physical share certificate will be given to the company. Suppose the company has not issued a physical share certificate, then at least a letter of allotment would have been sent. We are pleased to inform you that we have allotted 60 shares of Dubacor Limited to you. That letter of allotment is some sort of a proof of the share. Okay? Correct. Mr. Pranav Natarajan uses the word varisu, which is the Tamil word for legal heir. Varisu means legal heir. It is the point. It so happens that this is also the name of a recently released movie. Okay, the name of Mr. Pranav, I think wantedly has put it here, because that is also the name of a recently released hit movie of a superstar called Mr. Vijay. Okay, very popular movie now in Tamil Nadu. Pongal release, everybody is watching that movie and not concentrating on the CA exam. I hope not. I hope you are not wasting time watching stupid movies like Varisu and Tunivu and all. Rather, you are studying for the exam, because this 6 months in your life will never come again. Vijay will release one more movie. Arjit will release one more movie. But the 6 months won't come again in your life. Okay? So then you can always watch a number of movies. Sorry, this was uncalled for, but just thought I will add that point. Okay. Accompanied means attached along with the sent whatever. Okay. Now I am becoming more of an English dictionary. Yeah. Okay. Now, see, Radha, the original allottee of 2,000 equity shares in Murthy Mechanical Toys Private Limited, has transferred the same to Ruchi. The instrument of transfer dated 21st August 2020 was duly stamped and signed by Radha, was handed over to Ruchi. Advise Ruchi regarding the latest day by which the instrument of transfer along with share certificate must be delivered to the company to register the transfer in its register of members. So, you have to count number of days, 60 days, correct? Do you remember 60 days? Okay. So, latest day by which the instrument should come. Hint, this is what you're going to learn here. Do not include date of execution. So, the instrument of dated 21st. So, don't include 21st. Okay. 60 days. 60 days. So, you have to start counting from 60 days. From 20th, 21st is out. So, 22. So, 22 to 22, 23, 24, 25, 26, 27, 28, 29, 30. August has 31 days, 31. So, 10 days in August, 31st August. 10 days over. So, balance I have to count another 40 days. I'm sorry, 50 days. That 50 days, then what happens? August over. September 30. September 30. 30 days over. Now, October. I have to count another 20 days. So, the answer would be 20th of October 2020. Okay. So, 10 days gone in August, not including the date of execution. Then 22 to 31st, 10 days gone. Then 30 days in September. Then 20 days in October 20th. That is the correct answer. Okay. What I'm planning to do is, I'm planning to discuss those questions in the, I think by MCQs you mean my assignment questions, right? Correct. Not only will I upload the answers, I will discuss it in class. I will give the reasoning for my answers also. I won't just upload blindly answers. I will give the reasoning also. Okay. So C is the correct answer. Hint, do not include date of execution while counting the number of days. Got it? C is the correct answer. So with this test question, I am not trying to test you. I am teaching you so that you will remember that the date of execution should not be included. So therefore, C is the correct. We still have 3 months more. Correct. Not even 6 months. Agreed. Whatever. So again, don't get tensed also. Aram say cool. Okay. Cool. Don't be tensed also. Relax. Plan. If you have got a plan, execute the plan. Don't tense. Okay. Getting tensed is also bad. Am I correct or not? Remember what Krishna told to Arjun in Bhagavad Gita. Sthita prajna. Karmanyeva atikaraste. Mahapaleshu. Do your duty. Don't worry about the results. But do your duty. Calmly. Okay. Take the arrow. Notch it. Draw it. Aim. Carefully release it. Shoot. You'll hit the target. It's only when you're getting tense, the hand will shake, shiver. No need. Okay. Have confidence. Automatically, you'll fit. Since I've quoted Bhagavad Gita, let me quote another famous verse from the Bhagavad Gita, which could be inspirational to you. Yatra Yogeshwara Krishno Yatra Partho Dhanurdaraha Tatraha Sri Vijaya Bhutir Dhruva Nitir Matir Mama. This is told by Sanjaya, last verse of the Bhagavad Gita. He says, wherever Krishna and Arjuna are there, Yatra Yogeshwara Krishno Yatra Partho Dhanurdaraha Tatra Sri Vijaya means victory. Sri is not just money, boss. Sri is prosperity. Okay? Victory. Vijayo, Bhutir. Okay, you have brain. You have Dhruva Nitir, Matir Mama. This is 100% true. He says, Sanjaya, the minister of Dhritarashtra, tells Dhritarashtra. So, what we mean here is, what do you mean by Yatra Yogeshwara Krishna? Keep the Lord with you. You are Arjun. When he is with you, there is no way you are going to lose. Have that confidence and automatically you will be able to win. Good. But see, this studying till 2 a.m., sorry, boss. I'm not impressed. I don't care how much long you study. I'm more worried about the planning. I'm more concerned about, do you have a plan? Do you have a thing? If you're working to plan, it doesn't matter. Even if you study less, no problem. But work to plan. Okay. It's not how long you're studying. It's what you're doing in that time. Plan. Remember and do it. If that you're doing, then don't bother about 2 a.m. and all. This 2 a.m., I've been hearing it so many times, I'm getting sick. Don't put 2 a.m. again in my query pad. Okay. For example, I used to get up at 4 a.m. and study. I never used to study late in the night. I used to get up at 4 a.m. in the morning and study. It depends when you are comfortable. Your biological clock. Your biological clock is comfortable in the night? Okay. If your biological clock is comfortable in the morning. If you're trying to overcome sleep and studying, you're wasting time. Rather sleep. If you're not feeling sleepy and you're studying, good show, go on. Are you able to understand what I'm saying? So, 2 a.m., already feeling, don't do that. If you're not feeling sleepy, then go ahead and do it. Then sleep obviously, if you're going to wake up till 2 a.m. every day, Baba, you will have to sleep at least 3 hours in the daytime. Otherwise, you know what will happen? If you don't sleep till 2 a.m. in the night, and you also don't sleep in the daytime, by the time of examination, you will become nervous wreck. Okay, don't allow that to happen. Everybody needs minimum 8 hours sleep every day. How you take that sleep is your choice. But that sleep should be given to the body. If you do not give it to the body, you will become weak. Your nerves will become tight. Don't do that. Okay. I'm sorry. The minute you said 2 a.m., again, I'm giving a sort of a negative feedback. No. So I'm not impressed by 2 a.m. I'm more worried whether you're getting normal sleep. Minimum, come you need 7 hours sleep. If you're not getting 7 hours sleep, okay, sorry, you're putting yourself in difficulty. Later, nearing the exam, you're going to be nervous. Don't do that. Of course, reading in the night is a choice. But if you're going to read in the night, then compulsory you have to sleep for 2 to 3 hours in the daytime. Maybe after 12 o'clock to 2 o'clock, you sleep. Nothing wrong. Sleep tightly. You'll feel sleepy anyway. Exactly get up at 2 a.m., have a cup of coffee, 2 p.m. Have a cup of coffee and start preparing again. But ensure that you get some kind of a sleep there. It's important. Good. So, you see, in my case, when I was young, when I was 18, 19, 20, I used to get up early in the morning. I used to get up at 4 a.m. in the morning and study till 8 a.m. Then again, I'll relax for a little bit. Then again, I'll start studying from 10:30, go until 12:30. Then have my lunch. In those days, we used to have lunch at 10:30 and all. So 12:30, I'll go to sleep. I'll sleep for about 1 hour or so. And then 1 hour I'll sleep. Then I get up. My mother will give me coffee. Then again, I'll start studying. I'll go until 5:30, 6. Then 6 to 7:30, relax. Go for a walk, go to the terrace, fresh air, come back. Then again, I'll start till 7:30, go till 10:30. And go to bed. 10:30, I'll go to bed. Get up at 4 a.m. again. This was my routine when I was a student. Now, if you wanted to study till 2 a.m., then the same you have to make up somewhere else. You can't study. In fact, you can't study for 27 hours a day. Baba, there are only 24 hours in a day. Minimum, you need 7 hours sleep. Check it out. Okay? Not sleeping and studying is not an achievement. Don't spoil your health. Study, but don't spoil your health. Automatically, you will be able to. But the beauty is, as I'm becoming older, I'm not able to get up very early. I get up at 6:30 in the morning, but I go to bed only at 12 o'clock. As I'm becoming older, my need for sleep is coming down. Okay, I don't need now 8 hours sleep. 6 hours is enough for me. Okay, so I can sometimes get 5:30, but I go to bed at 11:30, 12. Okay, since somebody asked that question, I'm giving the answer. Fantastic. I hope these discussions are doing well for you. And thanks for allowing me to give you some possibly related but not relevant inputs. Next class on Wednesday, we will further continue with transfer and transmission, and then go on to buyback, all that sort of stuff. Okay, fantastic. Have a great evening ahead. Wish you all the very best. See you again. Bye.